The biggest mistake when planning for your insurance is the failure to do your due diligence before committing to an insurance policy. Now in this video, I will share with you 3 reasons as to why you should compare your insurances before buying. For the purpose of this video, I will be using the whole life insurance instrument as an example to substantiate my explanation. Without further ado, let's get started. Reason number 1. It literally costs you money to not compare. For the same level of sum assured, you will realize that there is a huge disparity in the price that companies may charge you for. In fact, the difference between the cheapest and the most expensive provider goes up to 70%, of which the nominal price differences between companies can easily be in the range of thousands of dollars a year. Now, if you do not do your due diligence, you are running the risk of paying for a more expensive insurance policy without understanding if it is even worthwhile to pay a higher price for the same level of sum assured coverage, which is why it literally costs you money to not compare your insurances before buying. Reason number 2. Differences in the scope and definition of coverage. Now, while the insurances within the same category often provide coverage for the same type of scenarios, the way the company may define the scenarios as well as the scope of coverage may differ from company to company. For example, while whole life insurance providers do provide coverage in the areas of total permanent disability and critical illness, the type of definition that they may adopt to define total permanent disability as well as the number of critical illness that they may cover you for will differ from company to company. Now, riding on to the previous point on price, having a clear understanding of what is being covered will help you make sense of whether or not the price that is being charged is worth paying for. Or are you being charged more for unnecessary features? All that being said, these facts and figures can only be brought to your attention if you compare your insurances before buying. Reason number 3. Different return and risk factor. For insurance policies that are participating policies, such as endowments and whole life insurance, the amount of estimated cash value as well as the percentage of cash value that is guaranteed will differ from company to company. If you are not careful, you might end up with a policy with a return that is significantly lower than the industry average as seen from a comparison between company A and CT. Or you may commit to a policy that exposes you to a higher market risk due to lower guarantee provided in terms of the cash value estimates as seen from company N. As such, if you are purchasing a participating insurance policy, you will definitely be better off by comparing the insurances and selecting a company that provides you with the suitable risk and return behavior that you need while balancing between the price and coverage that is received. Summary. Long story short, if you don't want to run the risk of overpaying for your insurance policy, buying an insurance that does not provide you with the definition and scope of coverage that you need, or committing to a plan with unsuitable risk and return profile, please do your due diligence and compare your insurances. Now, if you don't know how to get started with your insurance planning, or if you do not have the time to do your market research, you can consider engaging an independent financial advisor who can help you make sense of the market and shortcut your insurance planning process. To find out more information about how you can benefit from my financial and insurance planning services, you can check out what I do on my website and reach out to me directly. The link is in the description box below. Follow me on Instagram or Telegram to receive a 1-minute daily market update video and subscribe to this channel to stay updated with the future uploads. Stay safe and I hope to hear from you soon.